So the Winklevoss twins are taking their crypto empire, Gemini, public. We've torn apart their official IPO filing, that's the S1 document, to give you a crucial investor briefing. We are about to break down everything you absolutely need to know before the stock actually hits the market.
You open up their filing, and right there on page 1, a single word just jumps out at you: trust. In an industry that is, let's be honest, kind of the Wild West, they're positioning themselves as the regulated, safe and sound choice. And this isn't just some marketing fluff. It is the absolute heart of their pitch to investors.
And that, of course, brings us to the multi-billion-dollar question. A trusted brand is great, but does that make the stock a safe bet for your money? Well, to figure that out, we've got to look past the slogans and really dig into how the business works and what this deal actually looks like. All right, here's our game plan. First, we'll get to know the company and figure out how they make money. Then we'll dive into the financials, lay out the bull case versus the bear case, and finish up with the critical, must-know details of the IPO itself.
Okay, so let's start with the basics. When you buy a share of Gemini, what and who are you really putting your money behind?
So Gemini was kicked off back in 2014 by the Winklevoss twins, who you probably know as some of the earliest Bitcoin billionaires. Their whole idea is to be the regulated, trusted gateway into crypto. But it's not just an exchange, it's a whole ecosystem. They've got secure storage for assets, that's called custody, a credit card that gives you crypto rewards, and even an NFT marketplace called Nifty Gateway. That's a lot of different products for sure. But how does that whole ecosystem actually turn into cold, hard cash? Let's follow the money and deconstruct their business model. So if you look at where their money came from in the first half of 2025, the story is pretty clear. At its core, Gemini is a trading exchange. Almost 2/3 of their revenue comes from people buying and selling crypto. All those other services are growing, yeah, but trading is still the big engine that drives this whole train. Now, while trading fees are the main event, you can see they're trying really hard to branch out. They take a cut for helping users earn rewards on their crypto. That's a process called staking, and they make money every time you swipe their credit card. And this diversification is absolutely crucial for them because it helps protect them from the crazy ups and downs of the trading market. Okay, so that's how it's all supposed to work on paper. But what happens in the real world? Well, the numbers paint a fascinating and pretty complicated picture. As of the middle of 2025, Gemini had more than 500,000 people actively using their platform every single month. And that word actively is key. We're not talking about accounts that were opened and forgotten. These are people actually trading, staking, or using that credit card. That's real engagement. And get this, those users have parked over $18 billion worth of assets on the platform. That's a massive number, and it circles right back to that trust theme they keep talking about. You just don't leave that kind of capital sitting somewhere unless you have real confidence in their security. But this table shows the central dilemma for any investor looking at Gemini. The revenue is growing, which is great to see, but the losses, they are just huge, and they're getting worse. Losing over $282 million in just 6 months. I mean, it's that classic growth company story, right? They're spending a ton of money to get bigger, and profitability isn't even on the horizon yet. So, with a financial picture like that, you have to ask, why would anyone want to buy this stock? Well, let's put on our optimist hats for a second and look at the bull case. So the argument for Gemini really rests on a few key ideas. It's led by founders who are true crypto originals. That brand they've built on trust and regulation, it's like a magnet in a really chaotic industry. And as the big money, the institutions, starts looking for a safe way to get into crypto, a compliant US-based company like Gemini is sitting in a very, very good spot. And the size of the prize is just staggering. I mean, their own filing points to projections that tokenized real-world assets, we're talking stocks, real estate, you name it, all on the blockchain, could be a $10 trillion market by 2030. If Gemini can capture even a tiny slice of that pie, the growth potential is just off the charts. Of course, for every bull, there's a bear. So let's flip the coin over and look at the other side, all the risks and the fierce competition. You know, Gemini's greatest strength is also one of its biggest headaches. Playing by the rules in places like New York means massive compliance costs and limits on what products they can offer. Meanwhile, they're up against offshore exchanges that can move faster, offer more stuff, and do it all with lower costs because they don't have the same regulatory burden. The S1 filing basically lays out 3 huge company-threatening risks. First, regulators could change the rules and completely torpedo their business.
Second, a major hack or system failure could destroy that trust they've worked so hard to build. And third, their entire business is changed to the crypto market. If we hit a long crypto winter, their revenue could just freeze over.
And listen, these risks aren't just hypotheticals. The company admits it's been dealing with major lawsuits, including from the New York Attorney General and the SEC over its EARN program. That's a serious financial and reputational cloud that's going to hang over this stock for a while.
Okay, last but not least, let's talk about the IPO itself. And this is so important because you're not just buying a piece of a business, you're buying a very specific kind of stock with very specific rights or lack thereof. First thing you need to know, Gemini is going to be what's called a controlled company. It's a legal term that just means a small group of insiders, in this case the founders, will hold over half of the voting power, and that has massive implications for an everyday investor. And here's how they do it. They're using a dual-class stock structure. The Class A shares they're selling to you in the IPO, you get 1 vote for each share. But the Class B shares held by the Winklevoss twins, they get 10 votes per share. You can see how that math works out. It's designed to keep them in complete control.
So, what does this actually mean for you? It means the founders will have the final say on pretty much everything, electing directors, major company decisions, you name it. And because they're a controlled company, they're exempt from some key stock exchange rules, like needing independent directors to decide on executive pay. Basically, you're buying into the business, but you get almost no say in how it's run.
So it all comes down to this. The Winklevoss twins made one of the greatest venture bets in modern history with Bitcoin. They were right when a lot of people were wrong. Now with this IPO, they're asking you to make a bet, not just on crypto, but on them, on their vision, their leadership, and their ability to navigate this wild, unpredictable industry. So the question is that a bet you're willing to make?